Hello, everyone. Today we are talking about GDP, what it is, what it means, how we calculate it, and how we use it in our study of macroeconomics. So, as I just mentioned, we are in the field of macroeconomics. And just before we dive into GDP, just a reminder of why we actually do macroeconomics, why we study the economy as a whole, as opposed to only focusing on microeconomics, which is the study of individual businesses and markets. All right. Macroeconomics was born after the Great Depression when the government just honestly didn't understand how to fix the economy. Okay. There was over 25% unemployment in the United States, similar, if not more, in Canada. And the governments were just at a loss as to what they could do to actually fix that. And so out of this was born this study that we now call macroeconomics. And as I mentioned before, this includes two really, really important things that we want to create out of the work that we do. First, we want to be able to measure the health of the whole economy, of the economy of a full nation or a full area that is governed by one governing body, as well as being able to guide governments or the rulers of those nations on policies or things that they can do to fix the problem. Okay, so we need an accurate measurement of health, and then we need a solution of how to actually fix it. All right. Um, for countries, we are making the assumption that they have three main economic goals. So again, when we're doing our study of macroeconomics, we're trying to understand health and fix problems. We need to know what that actual goal is when we say fix problems. What do we want? We want economic growth. We want to limit unemployment, i.e. have lots of people with jobs. And we want to do our best to keep the prices of everything stable. Which has to do with inflation, which we're going to be covering more later. Okay. So again, in this whole unit, we're going to look at each of these things. But to start with, we're going to look at goal number one, which is to promote economic growth. And for this, we use GDP. Okay, GDP is our main measure to understand economic growth and therefore see if the things that we're doing to promote economic growth are actually working. Okay, so what exactly is GDP? GDP stands for gross domestic product. And what this means is it is the market value of all goods and services produced within a country's borders in a given time. Okay, there's a few terms here that are really, really important. Okay, the first one being market value. Okay, we want to know the value, the dollar amount. Okay, I don't just need to know that there was 3 billion apples grown in Canada. I want to know what their value was. Okay, because while we may have grown more apples this year, if we had to sell them for less, the actual value and the usefulness to our economy is going to be different. So when we're talking about GDP, we're always talking in dollar amounts or whatever the local currency is. We're doing this from a Canadian perspective, so that's why I'm saying dollars. Okay. So we're not just looking at the quantities, we're looking at the prices that they're traded at in markets, which can be difficult to track because we know that every business, every store, depending on the market that they're in, is selling them at different values. Okay. And so we're just looking at that market value. Okay. So that's the first part, the market value of all final goods and services. Okay. So just to clarify, on the final goods and services, I think we're going to dive into this more in a second. Yes, here we go. Okay, so what exactly is a final good? This is a product or a service that will not be processed any further, okay, and will not be resold. We are only counting the dollar value of items for the last sale that happens. We would include bread that was purchased at a grocery store or a bakery to be that is sold to a household that's going to eat it. Okay, or sold to the person that's going to hand it to the person that's going to eat it and use it. But we would not include bread that is being purchased by a restaurant where they're going to then turn it into a grilled cheese sandwich and then sell it again. Okay, it's only that final sale that happens to the end user who either is going to use it or is going to give it to the person who's going to use it. There's no additional selling that's going to happen. Okay. And as I said, it doesn't include what we call intermediate products, which is anything that's going to be have anything done further to it. So again, we know there's lots of businesses out there. You know, you go on Etsy and you see people who are, you know, adding labels to water bottles and selling them again. So the sellers of the original water bottles would need to keep track of who they are selling it to. Are they selling it to an end user who's going to use it, or are they selling it to a business who's going to do something to it to further process it? In which case, that would not be included in the GDP. Okay. Um, as I said, we don't include those intermediaries because what would result is that our GDP would end up looking too big because things would be double counted. Okay, and so we use what's called a value added approach. So we're going to start by looking at photocopy paper. Okay, so a few of the times that things are sold in the process of creating just blank white or colored photocopy blank paper, okay, there is going to be some sort of logging efforts, and there is going to be wood that would be sold to a manufacturing plant. Okay, and in this case, we're saying all the wood that's needed for this pack would be sold for $1. Okay, we're then going to have the manufacturers take that wood, they're going to break it down, they're going to turn it into pulp, they're going to run it through the machines, they're eventually going to result in actually producing the large reels of paper that you can see in this image in the middle here, okay, that they are then going to sell to another company for $2.75. Okay, that final company is going to cut up the paper, it's going to put it in this packaging, okay, or maybe it even just received it in this packaging, but they placed it in their staple stores so that it's easy for us to get to, and they're going to sell it for $4. Okay, so if we look at this a little closer, if we actually just recorded every time anybody bought anything, we would have seen that the first purchase was $1, then the second one was $2.75, then the last one was $4. So if we added all that all up, we would say that this pack of paper had added $7.75 to our economy. Okay, when in our reality, it didn't. Okay. Because if we look at this paper company, for example, well, they sold it for $2.75. That $2.75 was not all contributed to our economy. That was not all put towards people's wages and given back to the economy. $1 of that was given to the logging company. Okay. Which we've already counted as a contribution to our economy. So really, the paper company only added, when we're talking about value added, they only added $1.75 to the economy. Again, with the final ones, they didn't add $4 to the economy. That $4 isn't completely going into people's wages for them to be able to put it back into the economy. No, they had to pay $2.75 right to this paper company, which is already being counted. So when we subtract that out, this retailer is only adding $1.25 to the economy. And you'll notice here, when we add up the value added method, we end up with $4. $4 is the amount that has been added to our GDP or to our economy. And what you're going to notice, please don't check out yet. What you're going to notice is that that $4 is the same as the end of the retail. So while we say we use the value added method, okay, it's a lot easier and it's the same amount if we just only track the final sale, the sale to the final customer, as I was saying before. Okay, because then we don't need the rest of this information. Because again, it's nice when I have it on a chart like this, but when we think about real world, when we think about the government trying to keep track of all of the things that all of the businesses buy and sell, okay, it's a lot easier to just say, okay, we only need to hear from the end people, the people that sell to the people that will consume the product. Those are the ones that we're going to track. Anybody else that just sells to other people that are, or other businesses that are going to do something with it, we're not going to worry about it. Okay. So the last part of our original question, if I just jump back really quick, it said the market value of all final goods and services. So again, we talked about market value being the dollar amount. We talked about final goods and services being only that end amount. And then finally, produced within a country's border. Okay. And key here too is the produced. All right. So what exactly does it mean? Okay. The items need to literally be put together or the services provided in Canada. Okay, so goods that are produced outside of Canada by a Canadian business are not counted. Okay, so Roots Canada, a Canadian business, they make their t-shirts in Taiwan. Those produced items are not included in our GDP because they were not produced in Canada. Okay, goods that were produced within Canada by a foreign business are counted towards our GDP. Okay, for example, our Toyota plant in Cambridge, as well as the one in Woodstock, okay, those are cars being produced, put together to their end state in Canada, even though the business that owns them and chooses what to do with that money is not a Canadian business. Okay, so it's really, really important that we keep this straight in our head. So for GDP, okay, we're counting the final production that has to happen in Canada. All right. And then finally, in a given period of time, we always need to be able to set a period of time, and we want that period of time to be consistent for when we're comparing things to each other. Okay, so generally we look at GDP by the year. Occasionally we will look at it by the quarter, which is 3 months. If you divide the 1 year into quarters, it would be 3 months. Okay, but generally we're going to get the best idea if we look at it yearly, because that's going to account for any seasonal businesses. All right, so how exactly do we do this? Okay, we can understand that original statement, dollar values of final products produced in Canada in that year. Okay, how do we actually go about calculating it? Okay, so our GDP formula, we generally look at it like this. And again, if you're not huge into math, don't get overwhelmed. We're going to walk through it. Okay, so we are going to look at the 4 main groups of people that buy stuff, because again, we're looking at the dollar value of the final goods and services. Okay, so we need to look at who bought it. Who is the people that bought it that are going to use it? Okay, so the first one, C, is our customers. People buy stuff, everyday people. So anything that you buy, that your parents buy, that the household that you live in buy, okay, whether it's food to eat, whether it's clothes to wear, whether it's the electricity for your house, okay, the internet that you're going to use, the haircut that you're going to receive, that's all under the category of customers. Okay, the next one, stands for investments, i.e. businesses buy the stuff. Okay, so if the businesses are going to buy them, and they're going to be the final users of it. So again, a business pays their electricity, a business buys internet, a business buys an end product that they are going to use. It's going to be categorized under this I, which is an investment. Okay, the next one is the government. Okay, the government also does make purchases and are the end users of things. Okay, the government purchases many things for schools, for hospitals. Okay, and again, if they are the end user or they are giving that item for free to the person that will actually use it. For example, the government pays for the internet that you would use in a school building. Okay, the government pays for the food that you would eat if you stay at a hospital. Okay, they would be the end user, and so that's counted in the G there. Okay, and then the XN has to do with other countries buying stuff from us. Okay, so again, it's the monetary value of the end goods and services that are produced in Canada. So while they are produced in Canada, they still might be sold to another country as a whole or to people in another country. We call these exports. Okay, so all of the money that is made by selling our items, and again, by I say ours, it's ours as a whole, of all the different businesses in our country that sell to other countries. In a Canadian perspective, okay, that's generally the easiest is going to be in the US. Lots of people live right along the border and they're going to be selling things there, but it could really be anywhere in the world nowadays with shipping. And again, if you're located, if you think about being located in, Europe, for example, there's lots of countries right there, really close by, that you would be selling stuff to on a regular basis, okay, as well as in other places of the world. And just to jump back, when we say net exports, this is talking about exports minus imports. Okay, this is accounting for things that we bring into our country, which is why we don't include originally, when we talk about the GDP, things that are made by Canadian countries that are then imported, because they are accounted for here. So net exports, we always want to take our exports, what we send out of the country, minus our imports, what we bring into the country. Okay. Again, while this is a formula, this is more just our understanding. I'm going to actually go through with you how to do the formal calculation step by step and what to include. But before we get there, I just want to talk about what's not included in our GDP. Really, really important, because those tricky teachers, they like to give you a long list of things, and not all of them are going to be included. So we need to be able to spot when something shouldn't be included. And the reason that they do that, they're not just cruel humans, okay, is because in the real world, right, the government has tons and tons of information that they have. They need to make sure that they are including the proper information to be able to get an accurate understanding. Okay. So again, we already talked about this concept of immediate goods, things that are produced, but then go on to have more production done to them. We don't want to include them. So it's really important when businesses, and this is often done through taxes, okay, when businesses at the end of the year give their information to the government to do their taxes, okay, the government says, hey, you don't have to pay taxes on your intermediate goods, things that you've purchased. That you then used for production. So businesses are like, hey, that sounds great, definitely. But really, this is a way that they're then able to track what businesses use as an intermediate good, right? There's a monetary benefit for the government or for the businesses to actually track this, and a way for the government to get this information. Okay. The next thing that we include is non-productions transactions. Okay. So again, in our definition of GDP, these are things that are produced, the monetary value of things that are produced in that time period in Canada. So anything that is being resold. Okay. Again, I use the terminology of used. Anything that is sold used doesn't get counted because it's already been counted when it was actually produced. Okay. So if you went online and bought a bike, okay, Facebook Marketplace or Kijiji or one of those places like that, and somebody else had bought it from a store and used it for a year before they bought it for you, I mean, great, we're not putting more things in the landfill, but this is not something that's going to be included in GDP. Okay, because it is the resale of something that was already tracked. We only look at things that are produced, that are new in that sale that is happening. So we could look at, again, like I said, used items that are being sold off, and they could be sold from a business to a person, but again, it's done as used. We see this a lot with house sales, right? You could say like, oh, so many people are buying houses, but if none of them are new houses, then that's not actually being included in the GDP. Okay, along with a number of other activities where people are selling them. Okay, this would also include the stock exchange. All right, the whole stock exchange is generally not included in the GDP unless the company, okay, again, a Canadian company that's producing in Canada, okay, was selling their stocks for the very first time. The Canadian Railway was selling stocks for the very first time. That would get included. But once they're on the stock exchange, if one of you is selling them to another person and you're doing it there, that's not included. Okay. And then finally, non-market activity. Okay. So like I mentioned, buying and selling stocks and bonds. Okay. This is not able to be tracked by the government. Okay. As well as anything that's done under the table. Often in Canada, we call it doing a job for cash is kind of the terminology that's there, which means a business is not going to keep track of it. Okay, or individuals are doing it. Okay, so there's no tracking, and that therefore no taxes being charged, and therefore there's no way for the government to know about it. Okay, this is sometimes referred to as black market if you're not supposed to be selling it without taxes being included because it would be illegal for you to do that. That would be considered black market. We also talk about under the table work. Okay, people will do work for a business or another person and they'll just pay them cash. We see this a lot in like the domestic cleaning businesses. People have somebody come to their home or their apartment and do cleaning for them and they just leave cash on the table for them. That person wouldn't have to pay taxes on it as income, and therefore there's no way for the government to keep track of it. So again, kind of that concept under the table, black market, cash jobs, those kind of things would not be included in the GDP. And the government knows that. They know that happens and they take that into account when they look at what the GDP is included. All right. So now that we know what not to include and what to include, we need to actually do the calculation. Yes, we're finally getting there. So there are two approaches to calculating GDP. One looks at income and one looks at spending. Okay, basically the two sides to this. Okay, spending is probably the most understandable given what we've just talked about. Okay, we look at what people have bought and therefore we know then what was produced and the value of it. But we can also look at it from an income perspective. Again, what the business is made in money also tells us what they sold. Okay. And while I do say there's two approaches, okay, you do need to know both of them. And I'm going to show you why in a minute, because we actually calculate both every time we calculate GDP. But we are going to start with the spending. The spending follows the formula that I already gave you. Okay. So you'll see the little red letters in here. Personal consumption, C, that's what customers have bought. Gross investment. Okay. This is investment. This is what businesses have bought. Okay. Government purchases, as well as our net exports. Okay, so a few things to note in here. Okay, personal consumption, that's generally going to be given to you as a number. The government has a way of calculating this, that's going to be given to you. All right, on to gross investments. There is a difference between gross investments and net investments. And so when you're doing this calculation, you need to be very careful about what number you've been given. Okay, gross investments include the purchase of all assets, i.e., big equipment, machineries, inventory, things to sell, buildings, etc., that are intended to be used to produce the revenue. Okay. So it has to be something that's used to produce it. It's not the item that's changing, right? The flour that turns into the bread that turns into the grilled cheese. No, we're talking about like the oven or the mixing machine or the building that all of this is happening in. Something that a business has to buy. They're the end users of that item, so it should get included to do it. Okay, we want to include gross investment. So it's important to note if you don't have that terminology on your sheet, instead you're going to look for these two words, depreciation and net investment. Okay, often the way businesses report this, you might see the words net investment and depreciation instead. And so this formula is kind of given to you in the reverse. If you take gross investments and we minus depreciation, we're going to end up with net investments. And if you've taken accounting, you'll know what these words means. If you haven't, honestly, at this point, you can just kind of hopefully just keep track of the words or take a deeper dive to understand them. But all we want is gross investments. Okay, so if we rearrange this formula to get gross investments, we would take our net investments and we would add back our depreciation in order to end up with our gross investments. Okay. Next, we look at our government purchases. Again, these would be just a number that the government's going to give you. This would be anything that they spent on goods and services. So the money they spent paving roads, fixing roads, there's always construction, healthcare, education, et cetera, et cetera. Okay. And then finally, our net exports. Okay. Generally, we are going to be looking at these. These are our exports, our foreign purchases of Canadian goods, minus our imports, the Canadian purchases of goods from outside of Canada. So again, you're likely just going to get given the numbers for total exports or gross exports. And you're going to get given a number for total imports or gross imports. And to figure that out, you need to take the exports minus the imports to get the net exports. Okay. And then finally, this last thing we're going to look at in a minute. So we're going to start with this. So I have given you some overarching numbers here. Okay. Again, I got them from a chart. Personal consumption. Here it is. We're going to assume this is maybe in the millions. Gross investment, government purchases, net exports. You're going to figure out what each of these numbers are. And again, if you weren't given those exact amounts, just rewind in the video to figure out how to calculate them. You're going to add them all up and you're going to have your GDP. Okay. And while I would love for us to just be done and have a little celebration, okay, we're not quite. Okay. Because as I mentioned, we have to do both approaches. So the next approach, this is the income approach. This calculates GDP by adding together all the incomes in the economy. Because again, we only get income from the items being sold, right? Every income comes from people then spending money. Okay, so what's included in the income approach? First, we take all the wages and salaries. This is direct payments to workers, including any benefits they've been given. So when a workplace gives somebody the money to go to the dentist, that's a benefit. A pension, that's a benefit, et cetera, et cetera. Okay, and so again, Any terminology, wages, salaries, benefits to employees, all of that gets added together. Okay. Next, we look at rent. Okay. This would be any income, money coming in to businesses or individuals when they rent something. Okay. So whether they rent out cars, whether they rent out houses, okay, that's all going to be money coming in. Okay. Next, we have corporate profits. Okay. Generally, these are paid to public businesses through dividends. Okay. Or it's kept within the business to grow it in the future. Again, that's likely just going to get listed to you. And then finally, we're going to look at interest. Again, money that's coming back to individuals or businesses because they let other people borrow their money. Okay. And so they make a profit from it. We're also going to look at depreciation for this. Okay. And as I mentioned before, this is considered the wear and tear on assets. Okay. And again, before that was included in our calculation to figure out our gross investments. In this case, it's included especially on its own. Okay. What this does is it allows our two approaches to get as close as possible. Okay. If this wasn't included, then our GDP would be underestimated. And it's a bit complex to fully understand why we would include this in our income approach. Okay. So at this point, we're just going to remember that it needs to be included. Okay. We also include indirect taxes. Okay. And what I mean by indirect taxes is this is the taxes on things other than the income that people make, like HST or property taxes. Okay. And then finally, we're going to include a statistical discrepancy. And this is included in both of them. And I'm going to talk about this in a minute. So if on the right here, we have the approach we just looked at for the expenditure approach. On the left, we have our income approach. And again, we're just looking at the list of items that I've included. Okay. Wages and salaries, corporate profits, interest income, rent, indirect taxes, and our depreciation. So we would just get these numbers from the government. We're going to add them all up. Okay. And we're going to get our total amount there. Okay. And what do we notice? Okay. Hopefully you notice that these numbers are unfortunately not the same. And this is the main reason why we have to do both approaches. Okay. There is going to be slight discrepancies between the two approaches. And so to get the most accurate number, we need to make sure that we've done both of them. And then we do this final step together. So we're going to do our income approach, get the total. We're going to do our expenditure approach, get the total. What we're going to do after that is we're going to look at them together. So we're going to take the higher of the two numbers. Okay, so our first one from income approach, we're going to subtract the expenditure approach. Okay, and in this case, it's $1. It's not. It's probably like $1 million or 100,000, depending on what these units are. But in this case, it's 1. Whatever that number is, you're then going to divide it by 2. Okay, there's two numbers here. We're going to divide it by 2. And so really, this is the difference that we have. In this case, it's 0.5. Okay, what we're going to do is this is what we're going to use as our statistical discrepancy. Okay, so for the number that is higher, we are going to subtract that calculated number, okay, which is going to give us a new GDP. On the other side, we're going to use the exact same number, but we're going to add it, okay, which is then going to update that GDP. And we now have that equal GDP because it's really, really important that your GDP calculated using your income approach is always equal to the GDP calculated using the expenditure approach. So most likely when you first do the calculation, they won't be equal. You then have to figure out your statistical discrepancy, add that in, and then you will end up at that equal point. All right. So I know that was a lot of information. The best way to really understand it is to go ahead and do a few examples yourself. Okay. So you can go ahead and tackle the worksheet, do the calculations, extend your thinking, and then check back and make sure that your answers are matching up with the answer key. Good luck.